This is Scott Becker with the Becker Private Equity and Business Podcast. Regularly, our short business and private equity updates are just a couple minutes apiece. Our interviews with some of the leading figures and thought leaders in private equity are longer, but typically only 10 to 15 minutes. We're joined today by Rick Kess. Rick's a partner at RSM. RSM's a leading sort of middle market advisor in the private equity world. They've become one of the leaders in sell side diligence and a ton of other areas in the private equity over the last 10 to 20 years. Rick talks to us about what he's seeing in the private equity deal market. And Rick, I'll tee us up with a study article in the Wall Street Journal this weekend about how big pension funds piled into private equity and now find themselves holding their interest, but there's been so few exits in 22 and 23 that the cash isn't coming out at the pace they'd like it to come out. And one of the stats they showed was 21, a banner year for exits, 22 and 23, down nearly 50% a year in terms of dollars being exited, deals exited. What are you seeing out there? At what point will we start to see some of the return of that deal market, that hotter deal market that we saw so much of in 21 and so forth?
Yeah, I mean, I think that's the question, everybody in the ecosystem really struggles with trying to figure out, what's it going to take? I mean, is it a massive cut in interest rates? Is it, positive news on inflation? Is it improvement in the labor market? Really, what are the levers that are going to matter the most? And, I think, the interesting thing that we're continuing to study and try to, figure out how to advise our clients around is, in today's world, the zero interest environment, it just doesn't exist, right? And I think many or most of the people that work in private equity became pretty accustomed to living in a fairly close to or zero interest rate world. And, that's just changed a lot of their mindset as it relates to when to exit a deal or when to, enter a deal. And I think because of that, I think, the one factor that I think is probably the most important factor that we continue to, work with our clients around is just interest rate sensitivity, given how most of the deals are financed through leverage. And obviously that impacts, their capability of returning the ROI they're looking to turn. But, I think those other major economic data points are important. Labor is important. Inflation is important. Consumer sentiment's important. But I think the most important variable in all of this is really where interest rates are and where we predict them to be in the next, 6 to 12 months.
Right. At the end of the day, if you're living in a leveraged model, which the private equity world largely is, then you're at a spot where you want to get returns. If your cost of capital is so high, it's very hard to make that work. And to your point, so much of the universe grew up in the last 10 years and so forth, where they've not seen a slower, higher interest rate environment. So it's a little bit daunting because we've seen a lot of companies and on a ton of roll-ups and bolt-ons and found themselves with cash flow a lot tighter than they expected it to be, even if EBITDA is still okay, but much tougher. And those issues like inflation and the labor force tie very closely together with interest rates because it's sort of a slowing of inflation and easing of the labor market, which will lead the Fed to reduce rates some. But that's really the limiting factor right now, isn't it? This sort of situation with the Fed. You have a business environment, just very hard to invest when you're looking at 8-10% and higher interest rates to actually, borrow with, right? It just makes it means that you have to do so well through the result. And there's not that many no-brainer deals out there. Rick, any thoughts there?
Yeah, I completely agree. I mean, I think, the no-brainer deals, so to speak, they kind of probably came and went to some extent. And I think the no-brainer deals, the sellers of those businesses, they're really still demanding a pretty high return or a high multiple on their EBITDA. And I think because of that, unless sellers' expectations really start to shift, the interest rate environment is really kind of stuck where it is. We may see some, improvement in the latter half of this year. I mean, I know the Fed just met, kept interest rates the same. On their dot plots, they kind of indicate that there's hopefully one one reduction in interest rates in this calendar year yet to come. But that's still just hope, right? And so I think there's really not that many levers in terms of making an ROI on a project work the way you want it to work. I mean, you really have to make interest rate work the right way, or purchase price. And as of right now, some sellers are willing to take a haircut, but the sellers of those no-brainer assets or those really well-performing assets, I think, are still holding strong, thinking, we're still able to provide our management fee, and we're still able to, have some positive cash flow for our investors. Maybe not the cash flow that they're looking for, but we're not, losing money at this point in time. So let's hold tight and wait until we can get the return or the EBITDA multiple we were looking for maybe a year or 2 or 3 ago, where that EBITDA target's maybe a little on the high side of what would actually get transacted today.
No, I think that's fascinating because people don't want to exit in a suboptimal interest rate environment where they can't get the highest price possible. And the challenge they've got is some of their investors are looking for some cash back out, but trying to fit that balance of pleasing their investors and not cashing out at what is a tough market to cash out in. What a fascinating situation. Rick, thank you as always for joining us on the Becker Private Equity and Business Podcast. I always learn something talking to you and your colleague, Matt Wolf from RSM, brilliant people and followers of the private equity business. Thank you so much for joining us today.
Of course. Thanks for having me, Scott.